this video, I am going to explain the capital gain tax, how it is exempted from the sale of some assets, specifically focusing on mutual funds as NRIs if you are investing in Indian market through mutual funds. And if you plan well, you may not have to pay any capital gain tax. Hello everyone, welcome to Keerthi's FinFo NRI community. I am CS Keerthina. I live in Dubai. I run the consultancy, a firm which is specialized in NRI services. I have done my CS from India and CMO strategic level from UK. And I am also a SEBI registered overseas MFT. Every week, I bring and explain a video on the topics related to NRI issues in this channel. If you are looking for finance, tax, FAMA and investment topics related to NRIs, please subscribe this channel. When an NRI moves out of the country, he always looks at the investment opportunity for the family back there or his own stability. At this stage of the growth prospect India is holding, where it can be the third largest economy also, investing in India for long term makes more sense. But two things always bothers NRIs. One is currency depreciation. Second is taxation. Let us take up the currency depreciation in another video, and today let's dig deeper into the tax implications. What if I say, as NRIs, if you are investing in Indian market through mutual funds and if you plan well, you may not have to pay any capital gain tax? Yes, you can do that by taking advantage of DTAA, double taxation avoidance agreements that India has signed with many countries so that no individual or corporate is taxed twice. This can be used for us NRIs also to our advantage. This can help us to get the tax refund or exemption if you are residents of few countries, and this is available only for few type of investments including mutual funds. Our firm The Consultancy provides both mutual fund investing and tax services. NRI clients prefer us because we act as one point solution for your investments. So when you invest or redeem mutual fund units, we take 360-degree angle and we help you to maximize the return. As NRIs, if you are looking for this one-point solution, The Consultancy may be the place for you. If you want to book an appointment, use the link available in our website www.keerthisfinfo.com or link in the video description. However, in this video, I am going to explain the capital gain tax, how it is exempted from the sale of some assets, specifically focusing on mutual funds for the residents of some countries, again with GCC as a focus point. Because I live in Dubai, so I will be referring to the DTAA of India with UAE as an example to illustrate this point. So before diving deeper into this topic, let's see what triggers taxation in India. How these heads of incomes they are calculated. What is DTAA? How the relief is generally obtained under DTAA? Or which countries have such DTAA relief which is available to their residents, and how to avail that? So stay tuned till the end. So let's start with our first questions. What triggers taxation in India? So for any tax liability to arise, there should be some gain or income. So the general definition of income means any monetary return that one is receiving from business, job, investment, asset transfer, etc. For the purpose of taxation, tax liability comes on the total income. In India, the heads of incomes are salary, house property, business and capital gain. Again, one more important point to note down here is residential status of an individual. See, there are two types of taxpayers: resident in India and NRI, us. For resident, foreign income is taxed. For NRI, Indian income is taxed. But foreign income of NRI is outside taxation. Confused? To give a simple example, if you have invested in the shares of Indian company and received dividend or getting some rental income as an NRI, then you should pay tax in India because it's Indian income. But sitting in Dubai, what one is earning won't be taxed in India. Now, what is interesting here is the units of mutual funds in India, when they are sold by residents of some countries, though they are Indian mutual funds, they won't be taxed. How and why? I am going to explain in detail at the end. Now let's go to the next question. What is DTAA? Now that we have understood the residential status is so important criteria in determining one's tax liability, you should also understand that you can be resident in two countries at the same time. For example, Mr. Ramu is holding UK citizenship and he stayed in India for more than 6 months in the previous year and he becomes resident in India. Or Somu, an Indian resident, might be having income from US stocks or rental income from Dubai. See, post-COVID, there are many digital businesses who do business remotely and do many cross-border transactions. So this is just a simple example, but please understand that tax residence is determined based on highly complex, diverse set of domestic laws. So while traveling or investing, staying in a particular country, we don't bother about it. Right? That's why DTAA exists. Double Taxation Avoidance Agreements. The name itself has suggested the purpose of it. DTAA covers the range of income sources such as royalty, interest, capital gain, dividend income, etc. So, they specify which country can levy the tax and at which rate. When you become tax resident in both the countries or more than one country, the transaction is taxable in both the countries, then only this DTA is applicable. It also says whether you have an exemption or whether you can take tax credit, how the relief is obtained. So, now what should you do? Follow these two steps. Find out what DTAA specifically says about the income you are having and decide the tax liability both under DTAA and under the Income Tax Act and choose the one which is more advantageous. Means as a taxpayer it is up to us to choose how we are going to be taxed under IT Act or DTA. It is not compulsory, it is optional. If someone doesn't want to break their head over these double taxation agreements, they can simply choose to be taxed under normal provisions of IT Act. Section 90 covers the treatment where India has DTAA and Section 91 of IT Act gives the relief where there is no DTAA. So this is completely optional. Now it is the time to analyze the most important part, that is capital gain tax exemption for NRIs in some countries. I have referred the treaties of Saudi Arabia, Oman, Qatar, UAE, and these DTAAs have the provision which is almost similar to UAE. When we are taking example of DTAA signed between UAE and India, there Article 13 Clause 5 clearly says these following four categories are excluded. What are they? Excluding the gains of sale of immovable property, land or building, anything. Movable property which is forming the part of business which has a permanent establishment in contracting state. Stock of Indian companies. All other gains are to be taxed in the state where SSE is a resident. So when you are studying the DTAA of Oman, this is found in Article 15. Saudi Arabia, Article 13 Clause 5. Qatar, Article 13 Clause 6. They all say the same thing. Gain from alienation from any other property other than these four mentioned categories are going to be taxed in the place where SSE is residing. That means not in India. In the place where you are currently residing. And this may be available in other DTAAs also, but I have not studied them. So I will not be able to comment under which clauses such relief is available, but the countries that I am mentioning, that is Oman, Qatar, UAE as well as Saudi Arabia, these are clearly mentioned. And please note, Bahrain is not included here because it is in no DTAA zone. That means there is a treaty only for exchanging the information, but there is no DTAA signed between India and Bahrain. So whoever is residing in Bahrain, they won't be able to get the relief. See, these DTAAs, they clearly mention all the heads of income such as business profits, income from immovable property, shipping, transport, royalty, interest income, dividend income, how they are going to be taxed and which country can tax. Now this has excluded mutual funds here. So the only thing that has to be established is tax residency, and remember, in case of any conflict, it is only DTAA provision will prevail. Now I am very sure you will be thinking stock and mutual funds, they are indirect way to take exposure in stock market, right? So what if IT department contends that mutual fund units are like stocks and there won't be any exemption? Don't worry. There is a ruling where IT Tribunal has held that units of equity-oriented mutual funds are not the shares for the purpose of article related to capital gain in UAE, India tax treaty. So now what is the step to be followed? When you are transferring a capital asset, remember, unless and until there is a transfer of a capital asset, there is no tax liability. That is where you are selling the MF units. There is an incidence of tax liability in India. So it is the point where you have to think of availing the benefit of the treaty signed. So, in order to establish the tax residency, you need to obtain TRC or Tax Resident Certificate from Federal Tax Authorities of UAE. In UAE, the procedure is completely online, and in case of tax registrant assessees, it is 500 dirham, and non-tax registrants, it is 1000 dirhams, and it is actually a very quick process if you are submitting all the documents which are required to prove. Applicants must submit passport, valid visa, Emirates ID, lease agreements, bank statements as a proof to show that this has been a place of residence for you. Then you have to get Form 10F from the tax portal and apply for the refund of the capital gain tax. This form is a self-declaration form by NRI SSA to claim the benefits under DTAA for the purpose of getting the refund. Because if the TRC is not containing all the details which are required to be furnished, then 10F should provide that. Section 90 clause 5 says NRI must produce TRC and form number 10F. But please note, the case is not so simple as I am telling. It is actually more complex. And to stand on the right side of the law, correct interpretation is necessary. So always seek professional help in case if you are in doubt. Let me explain why. See, even if we assume that a person has stayed for more than 182 days in UAE and obtained TRC, at the time of applying the rule of residential status in India, remember this is not just based on how many days you have stayed in previous year. So more than the physical presence, there are certain other criteria which has to be applied. So what if you ended up becoming resident of India when we are applying other provisions which are there in the Indian taxation? That means DTAA specifies that the rule is different. You have to apply tiebreaker mechanism. That means there are some additional tests which has to be applied. To just put it simply, they are 4 criteria. Where is a permanent home? And where is a significant economic relationship or habitual abode or nationality? So applying these all 4 rules, you have to actually establish the fact that I am the resident of this state. Matter is not so easy to interpret and it can be really complex. So in case if you need any professional help, please reach out to us. You can just mail to info@keerthisfinfo.com and we will be more than happy to assist. I know that the topic of DTAA is not so easy to understand. It is actually a very complex topic. But still, I tried my level best to keep it simple and explain in layman's language. I hope you learned something new today. If you have any doubt, please mail me at info@keerthisfinfo.com or you can even mention the doubts in the comment section. That's all for today. See you again next week. Bye-bye.